Hey guys, my name is Rahul Shah and I welcome you once again to this YouTube session where my goal is simple. It is to make investing accessible and profitable for the average investor. Now we are in the middle of a crash course in penny stock investing, and over the last couple of videos we've learned two very important lessons in penny stock investing. So let's just recap those lessons. Lesson number one was very important. When it comes to penny stocks, not any time is a good time to invest in penny stocks. Now, what I mean by that, you see, blue chips, you can invest in blue chips at any point in market cycle and it's not going to impact your long term returns, but that is not the case with penny stocks. Penny stocks are a different beast altogether. When it comes to penny stocks, your best chance of earning very good returns on penny stocks is at the start of a bull market, or when the market has fallen 25, 30, 40% from its top, and you will end up losing a lot of money in penny stocks if you invest at the top of a bull market when the market has gone up 100 200%. So the idea here is to maximize your exposure to penny stocks when the markets are at the start of a bull market cycle, and minimize your exposure progressively as the market goes up and it reaches the top of a bull market. So maximize your exposure when the markets have fallen a lot, and minimize your exposure after they have gone up a lot. So that's point number one. Now point number two was something we learned in the last video session, where penny stock investing is not just about finding tomorrow's winners. Now, using the theory of inversion, I highlighted how penny stock investing is all about, is also about avoiding tomorrow's losers. A lot of people invest in penny stocks based on the first premise that penny stock investing is all about investing in tomorrow's winners, investing in finding the best penny stocks with the best growth prospects. But according to me, a better method, a more effective method of investing in penny stocks is when you invest in stocks which don't end up being tomorrow's losers. You try to minimize your losses and maximize your gains. You try to take care of the downside so that the upside takes care of itself. This is what even the field of value investing is based on. It is the foundation of value investing. That value investing, first and foremost, is not about losing money, and then secondly, it's about earning good returns. So those were two critical lessons that we learned over the course of the last two lectures. Now it's time for lesson number 3 in penny stock investing. Today I'm going to be talking about the most important ratios, or the most important data points, or the most important pieces of information that will help you zero in on the right penny stocks. If you want your penny stocks to have a better than average chance of becoming a multi-bagger in the long term, becoming a multi-bagger in the medium term, what are the ratios, what are the numbers you should look at, and how you should go about finding that. So that's going to be the focus of my lecture today. So without any further ado, let's jump into this particular discussion. And to start the discussion, I have a very important case study lined up for you today. Now this case study was designed by a world famous psychologist called as Paul Slovich, who in the early 1970s designed a very interesting experiment. Now in this experiment, what he essentially did was he invited 8 horse racing experts, people who bet on horse racing for a living, to predict the outcome of 40 horse races. So he invited 8 experts to predict the outcome of 40 races, and these races were divided into 4 different groups of 10 races each. So the round 1, or the group 1, will have 10 races, round 2 will have 10 races, round 3 will have another 10 races, and round 4 will have 10 races. So 40 races divided between 4 different rounds, and the only difference between these rounds was the amount of data, or the kind of data that was given to these horse racing experts. In the first round, each expert was supposed to make a prediction of the horse race based on just 5 data points. Each expert was given only 5 data points. Now these 5 data points could be any data points that the horse the horse racing expert would like to have. It could be the age of the jockey, the age of the horse, the speed, the fastest speed that the horse has achieved historically, or the age of the horse. He can have any data point on a particular horse, provided he restricts his information to just 5 data points. So round 1, you have to predict the outcome of a race or horse race based on just 5 data points. Round 2, the number of data points increase to 10 data points. So instead of 5, now each horse racing expert will have to make prediction based on 10 data points. He will be given 10 data points instead of the 5 data points that he was given in round 1. Round 3, the number of data points increased to 25 data points. So now each horse racing expert will have an access to 25 data points, 25 crucial pieces of information on each horse with which he can make the prediction. Round 4, the number of data points further increased to 40. So now he will have as many as 40 data points to predict the winner of the horse race. So first round 5 data points, second round 10 data points, third round 25 data points, and fourth round 40 data points. Now something interesting happened when he collected the results of this experiment. He found out that when the number of data points went from 0 to 5, the accuracy rate also increased. So if you have absolutely no information on any horse and you have to predict a horse race, then it becomes nothing less than a gamble. It's a wild gamble where the probability of success is 10% because you are predicting a winner out of 10 horses. You're predicting the winner of a horse race which has 10 horses, and if you have to make a wild guess without any information, your probability is 10%. Now when at the end of the first round these experts were provided 5 data points, their accuracy rate increased from 10% to 17%. There was a 70% jump in the accuracy rate of the horse racing experts when they were given 5 data points, and their confidence also increased. They were more confident of predicting the winner as opposed to the previous round where they were given 0 data points and they had to just make a wild guess. So not only did the confidence level also increase, the accuracy rate also increased. Now here comes the interesting part. Round 2, when they were given 10 data points, what happened? The confidence rate further increased. They were more confident of their outcome, but did the accuracy increase? No, it remained same at 17%. So even when they were given 10 data points, their accuracy rate, the rate of prediction, remained at 17%, although their confidence in predicting the outcome of the race increased further. Round 3, when they were given 25 data points, what happened? Did their accuracy rate increase? No, it again remained at 17%. The confidence increased? Yes, it increased even more than the second round. So when they were given 25 data points, their accuracy rate remained at 17%, but the confidence rate increased further. Round 4, 40 data points, again 17% accuracy rate. Accuracy rate has not moved an inch, but the confidence doubled as compared to the first round. So at the end of the fourth round, while they were more confident of their predictions, the accuracy rate remained the same. This is, I think, a very, very important lesson for all of us who are trying to predict the outcome of a complex event or a complicated race. Now, what is the key takeaway from this experiment? According to me, the key takeaway from this experiment is, while the number of data points matter, it is the quality of these data points that have greater importance. Beyond a certain number of data points, the extra data points do not matter. They do not improve your accuracy rate. They only improve your confidence in the prediction. So if you have the most high quality information, and even though it's a limited information, even though you have limited data points, but those data points are of extremely high quality, I think your accuracy rate will be same as the guy who has a lot of information to work with, but the quality of that information isn't that great. Now try and imagine this in the field of investing. On the one hand, you have a detailed research report on a company which is running into 30, 40, 50 pages, and it has captured every possible detail about the company. And on the other hand, there is just a one page report on a company which is not chock-a-block with information, which is not chock-a-block with data points, but which captures the 3-4 most critical data points that is essential to make a prediction about a stock's future in the stock market. It is as likely that the guy who's written a one pager but has captured all the important data points, he will have a better accuracy rate than the guy who's written a detailed research report, but the report is high on the quantity of information and not that high on the quality of information. It's similar to the horse race, where you have your data points, number of data points that you have at your disposal keeps on increasing, and it keeps increasing your confidence in your prediction, but it does nothing to improve the accuracy rate or the rate of success rate in your predictions. So this, according to me, is a very, very important takeaway in the field of investing. The quantity of data, the quantity of information that you have at your disposal doesn't matter. It is the quality of data points, the quality of the pieces of information that you have, the quality of numbers that you have, that matter a lot when it comes to investing, be it penny stocks or be it any other category of stocks. Now this brings me to a very important question: what are the 3-4 important data points, important ratios that matter in the field of penny stock investing, from which you are able to zero in on stocks that will increase your chance of finding multi-bagger penny stocks, or will go a long way in making you a successful penny stock investors? What are these 3-4 data points that are important? As I said earlier, the quantity of information does not matter, so you don't have to essentially burn the midnight oil in trying to understand a company to its minutest detail. What matters is you get hold of those 3-4 data points that matter a lot when it comes to penny stock investing, and then make your decision based on that. Luckily for us, Benjamin Graham, the father of value investing, has done this work for us, and he has outlined not 5 data points, not 4 data points, but just 2 data points. Yes, that's correct. Benjamin Graham is of the view that if you have to do a good job in investing in stocks, be it any kind of stocks, even if it can be penny stocks, if you have to do a good job of investing in stocks, 2 data points play a very important role. They will go a long way in determining how you perform in the field of penny stocks or any other category of stocks. Now, what are these 2 critical data points? So they are there on your screen right now. Data point number 1 is ensuring that you are buying a 100 rupee note for rupees 80. In other words, you're ensuring that you are having a margin of safety in valuations. If the intrinsic value of the company is rupees 80, you are paying not more than rupees 80 for buying that stock, for buying that company from the stock market. Data point number 2 is the company should have a sound financial history, or it should have a strong balance sheet, sound financial position. So if the balance sheet of the company is strong, that's another very critical data point. And Benjamin Graham was of the view that if you invest in stocks that will ensure that you're buying a 100 rupee note at rupees 80 and you're buying a company with a strong balance sheet, if only you look at these 2 data points, then there's a very strong chance that you will end up outperforming the market. You will end up making good long-term penny stock bets in the market. Now, why was Benjamin Graham confident that it is these 2 data points that matter more than any other data points? Why not look at the quality of the company? Why not look at the growth prospects of the company? Well, there are 2 reasons for this. Reason number 1, Benjamin Graham went back in history, went back 50 years to evaluate data of stock market winners and losers, and he came to the conclusion that most stock market winners, they satisfied the first 2 criteria. They were cheap as far as valuations are concerned, they were attractively valued in the market, and secondly, they had strong financial position. They had a strong balance sheet. And most of the stocks that ended up doing well in the market, or if you invested in a group of these kinds of stocks where you ensure that you're buying a 100 rupee note at rupees 80, and where you're also ensuring that the company has strong balance sheet, then there was a very strong chance that that particular group of stocks, or that portfolio of stocks, ended up doing well in the market over a long term, medium to long term period. So this the way he arrived at these two data points was going back in history and checking out what kind of stocks worked and what kind of stocks did not work in the market. There's another reason. If you remember, in the last lecture I spoke about investing in companies where your number one priority is prevention of a permanent capital loss, or where your number one priority is not to identify tomorrow's winners, it is to stay away from tomorrow's losers. So what this means is that if I'm investing rupees 1 lakh in penny stocks, my number one priority is not to turn that 1 lakh into 3 lakhs. Of course that's a priority, but number one priority is to ensure that that 1 lakh does not fall to 70,000, 60,000. I want to avoid a permanent loss of capital. I want to avoid a significant damage to my investments if I have to do well in the stock market. Of course I want to turn that 1 lakh into 2 lakhs, 3 lakhs, but first and foremost I have to take care of the downside, and I'll have to let the upside take care of itself. And if I take care of the downside, then the upside usually more often than not follows. So now the place where these two rules come in extremely handy, the two ratios that I spoke about come in extremely handy, is because if I'm investing in a 100 stock that's worth rupees 100, and if I'm paying only rupees 80, then the chance that there will be going to be that I'm going to incur a loss in my capital, my 1 lakh capital will become 70,000, 60,000, is I have eliminated quite a lot of that risk of overpaying. And if I'm investing in a company with a strong balance sheet, with a sound balance sheet, then I'm also avoiding the error that most people make of investing in a bad quality stock. Now the two biggest reasons why people lose money in stocks is they pay too much for a stock, or they invest in a company with poor balance sheet or company with poor quality. So what these two ratios ensure is that they take care of these two aspects of investing. It ensures that you're not paying too much for a stock, you're not overpaying for a stock, and they ensure that you're not investing in a bad quality stock by investing in companies with low debt to equity ratios. So those are two critical elements when it comes to penny stock investing. Two data points which go a long way in ensuring that you build a strong penny stock portfolio, a strong portfolio which will give you fantastic long-term returns. So we studied the case study, the horse racing case study, and from there we came to the conclusion that investing in penny stocks is all about the quality of data points, the quality of information. And if you restrict, even if you have limited data points, but the quality of the data points is very good, you can make good money from penny stock investing. And we took the help of Benjamin Graham in arriving at two very important data points, valuation data point and the balance sheet data point. So those are the two critical data points that will ensure that you make a good amount of money from penny stocks over the long term. Now in the next lecture I will see whether these two data points did actually work in the Indian stock market between 2014 and 2015, over the last 2020, over the last 5 to 6 years. Did these data points help us zero in on the right kind of penny stocks, and what are the kind of returns these penny stocks gave when we built a portfolio predominantly around these two data points? So we're going to see how this portfolio performed between 2014 to 2019, 2020, over a 5 to 6 year period, and see whether it did really work in the Indian stock market. So that was lesson number 3, and that was what I wanted to bring to your attention today. So next time we're gonna use these data points on the Indian stock market and how the penny stocks in the Indian stock market performed based on these two data points. So yeah, that was all from my side today. See you again next time. But before I leave, do not forget to press on the like button if you've liked this video, and also do not forget to comment if you have any comments for me. Please do it, because it really encourages me to keep coming up with good content. So till next time, goodbye and thank you very much.